Alright, hi everybody, welcome back to the channel, and I wanted to make this quick video to talk about how you can potentially make over $1,000 per week with the SPDR S&P 500 ETF. Now, full disclosure, it will take a certain amount of money to make this trade happen. We will discuss that in this video. So we will discuss how much you would actually need to make this trade happen, exactly how much in terms of the averages. Let's say over the last several weeks, if you look at a trade, you can kind of say, okay, well, I might need this much capital to perform it at this level based upon what I'm trying to achieve. So that's what we're going to go over in this video. Now, when it comes to this, you'll see that I have a sample trade laid out already. So if you have a Fidelity account or if you have a Charles Schwab account, whatever it is, even if you have no money in the account, you can still probably follow along with me. And what this is basically what we're doing is we're taking the bid price of an option. So first of all, we have to find an option. Now there's call options and put options. A call option gives you the right, if you're buying the option, to buy 100 shares at an agreed upon strike price. So in the case of SPY, right, this is the S&P 500 ETF, the main index for the S&P 500. And what we're looking at here is a chart that's consistently in an uptrend since November of 2023. As you can see, going back all the way, we've had some pullbacks, but if we're going to expect that this will continue and the bull market will continue, then what we can do, if we're doing this for the first time, let's say, is we can enter into a cash secured put trade. Now, the cash secured put is simply a way to get paid by purchasing stocks or purchasing ETFs such as the SPDR S&P 500 Trust. And so what we're doing here is we're basically buying the S&P 500, the major index for the market. And if we look at the technicals, we could say that perhaps we could see this retest all the way up to 580. So if we're going to assume, or even up here, 560, something like that. So, but if we say, let's say it's going to go to all-time highs, we're bullish on the market. So what we can say is, I'm going to place a trade at $540 per share. Now, what this trade is it's an out-of-the-money cash secured put. So what we're doing is we're agreeing to buy a specified amount of shares at the strike price of $540, and we're doing so. So today is August 14th. Tomorrow is going to be August 15th. What that means is August 15th to August 21st, 15th, 16th, 17th, 18th, 19th, 20, 21. So that's 7 days total from tomorrow. So what that means is August 21st at a strike of 540, we're agreeing to buy, in this case, since each options contract, whether it's a call option or a put option, is going to give you 100 shares of stock or an ETF. So in this case, we're agreeing to buy 500 shares of this ETF at $540 up until August 21st, 2024. Now, depending on what happens, if SPY is below 540, then we will get assigned this position. But regardless, we still pocket based upon the current price of the option. Now, this can change, keep in mind, but in this example, we're doing over $1,000 after commission, $1,086.75. And what this means is we have succeeded in our goal of getting $1,000 per week, right? So that's what we're trying to shoot for. And it takes 500 shares or 5 contracts to make that initial trade happen. Now, if we look at the price of 540, how much capital are we actually putting up in this case? So if we take 540 times 500 shares, it looks like the total amount of capital you would need to complete this trade is $270,000. Now, I know that might seem outrageous for a lot of people, especially when considering this from a retirement perspective. Who's going to put up that much for one trade? Keep in mind, would you put that much up based upon your own risk tolerance into the S&P 500 yourself? Because if you would, then maybe you're already invested in the S&P 500. Maybe you're already invested in an index fund or a mutual fund of some kind. Maybe you already have this in a Roth IRA or something like that. So do you have this, first of all? If not, we could always do it with a lesser amount. Now, the least amount you can do is one contract or 100 shares, $540 a share, right? So that's pretty expensive, you could argue. But if we're doing this, let's say for 100 shares, you can see how it's only $54,000 in that case. Now, we're not going to get to $1,000 on the 540 strike. In that case, let's try the 543 strike and see what happens. How much can we get for one options contract at the 543 strike? And it looks like $3 in this case. So we can get $306, and that's on a weekly basis up to the August 21st expiration. So as you can see, depending on the strike, if we try, let's say, 400 shares at a strike of 543, now we're talking over the amount that we need. If we try 3, now we're talking about $900, so not quite 1,000. But you can see how playing around with the numbers and also the strike price, and of course the expiration day, will determine ultimately how much you can generate. But in general, based upon what we're looking at here, a strike price of $540 gives us a little bit of leg room, because let's assume we don't really want to get long the S&P 500. Now it's at 543. That gives us basically a $3 discount per share if we have to get long. So if the S&P 500 goes down $3 in this next few trading days, we have a retracement down to 540, and let's say upon the expiration day the S&P 500 is trending downward to the 535 level. In that case, we would get assigned, and what could happen in that situation is we simply turn around and sell what's called a covered call. Now what we do is we try to aim for the same strike price. So let's say the S&P 500 is at 535, or roughly around that price, as you can see from the chart, and we're going to sell a strike at 540 once again. Now you'll see here in this case it's actually trading at 543. So since the S&P 500 is at 543.75 right now, let's adjust that pricing and pretend that we're just going to do a general out of the money call option in this case. So let's say 545, and we're going to try to aim for that premium, which in this case is over $4. And as you can see in this case, the 500 shares that we're talking about results in a credit of over $2,000. And this is in a single week, once again, because it's the August 21st expiration. So this is simply switching from a cash secured put to a covered call. And what we're really doing here is it's called the wheel strategy. The wheel strategy involves first entering into a cash secured put, and then once you get long the stock, or if you get assigned the stock, you turn around and sell a covered call. And this is a repeating cycle that continues hopefully into infinity. And the major risk with this strategy is that there could be some volatility. So if the S&P 500 goes down, let's say 20%, and you've entered into a trade like this where you have a covered call position at 545, but now the S&P 500 is down, well, now you're going to have to maybe wait for a recovery, right? Because you don't want to risk losing your shares at a lower price if you're selling a covered call against your shares, way below where you bought your shares initially, right? So that's one of the major risks you can have. Now, that being said, the S&P 500 is kind of like the benchmark for the market. So if you're looking at maybe not as risky of a way, like I've seen some ETFs even that will sell options against the NASDAQ, which is going to be a bit of a riskier strategy, right? Because the S&P 500 is the benchmark for volatility, for beta, and then you have the NASDAQ, which tends to be more, the stocks in that index tend to have a higher beta, more volatility, right? So when it comes to this, the S&P 500 or SPY options in general will give you that leverage. And one other consideration here with the wheel strategy, where we're selling cash secured puts and covered calls, is that you can earn over $1,000 per month by playing with these numbers, by figuring out, on certain trades how much you would actually get and how much capital you'd have to put up. We've already kind of ran the generic numbers. So in this case, at a 545 strike, even if you were just initially going to buy the shares and go ahead and enter into a covered call trade, you would need this much, which is over $250,000, right? So you're still going to need a sizable chunk. But the thing is, once you're over $1,000 a week, let's say you're consistently trying to hit 1,000 times 52,000 divided by 12, let's say, that kind of gives you an idea. If we're trying to aim for over $4,000 a month from this strategy, how much could you actually potentially make, right? So on a $250,000 portfolio, if you're looking at that and you actually do have that available to trade with or invest with, 20%, right? So that's obviously not considering taxes and if you're withdrawing these funds. And you can try to play around with the numbers to get more aggressive or less aggressive. But keep in mind with this, the main point I was trying to get at was that a lot of people think with options they need to buy a call option or buy a put option, try to bet on the specific direction to the point where their entire trade is dependent upon that big move, or hopefully some volatility creeps in their favor. And what I'll tell you is, I think with options, if you are selling options, you are actually the house. So if you think about a casino, how they have buyers of options and sellers of options, one way I like to look at this is that the seller of the option is often the house, and the buyer of the option is often the gambler going in there having some fun, a few drinks, and hoping to hit it big, right? Because if you buy a call option, you're hoping the stock makes a big move upward, and if you're selling a call option, buying a put option, then you're hoping the stock goes down. Or then in the case of an ETF, you're hoping the S&P 500 goes up by a lot if you're buying a call option, or if you're buying a put option, you're hoping that the S&P 500 goes down by a lot. Well, in the case of selling an option, you honestly are hoping that there's not a lot of volatility. And in a lot of cases, there's not going to be. You'll have these small movements up and down, but those days where the S&P 500 is down, let's say 5%, or those crazy days in the markets that we've heard of or we've experienced in the past where the markets take a huge nosedive, it doesn't happen a lot, but it can happen. That is a consideration in your trading strategy with this. And if you have a bad trade and you do lose, keep that in mind. But the question is, how can we get those consistent wins? I think one way to look at this, and one more thing on this strategy, is it's called delta. Now, delta is basically a measure of your risk in relation to your option going in the money. And so it's basically a zero-sum game between the buyer of the option and you're the seller of the option in this case, because you're selling cash-secured puts and you're selling covered calls in a rotating fashion known as the wheel strategy. And I will leave a link in the description on the wheel strategy just for your guys' information. But when we're looking at this, just remember that your main risk is that the option goes in the money and then you're forced to readjust your portfolio based upon the option going in the money for the buyer. And you're either forced to buy the stock or buy the SPY ETF at a price, or sell your shares, right? So there's two ways. You either have to sell your SPY shares or buy your SPY shares at the agreed upon strike price if the option goes in the money upon expiration. So that's your main risk, and that has to do with delta. So that's another thing. I'll leave a resource in the description about delta. It can get complicated, but this is the strategy in a nutshell. If you were following along with me in your brokerage account, hopefully this setup that we have right here, it's a hypothetical setup about how you could do this against the SPY, but it gives you an idea. You know, in this case, we're actually over double our initial goal of 1,000. But the thing is, by playing around with these numbers in our initial example, the cash secured put was at 540. We had 500 shares, and we were doing this for the August 21st expiration, which resulted in this case with the current bid price of $1,086.75. So that puts you over $1,000 a week. With that being said, thank you so much for tuning in. God bless. We will see you in the next one, and take care.